Today, we are going to start with another chapter from the accounting and financial management for the bankers, and this is going to be very much important because in this chapter, we are going to learn the concepts related to the simple interest, compound interest, annuities, EMIs, bullet payments, and everything. And we are going to cover the numerical as well, the case studies as well. So stay tuned and watch the video till end. And if you have been watching the videos for a while and if you have been liking the videos, kindly give this video a thumbs up and do not forget to subscribe to this channel if you have not subscribed yet, and press the bell notification icon so that you get updated whenever we upload the new videos. So let's start the session over here, and it's related to the accounting and financial management for bankers, and we are going to start with the chapter. And at first topic we are going to cover the simple interest. Now you must be knowing the simple interest formula. This is P into R into T divided by 100, because the particular rate of interest is to be converted into the decimal part, right? So P over here is a principal, so this is a principal, R is a rate, and T is a time, right? So if we have to calculate the interest on the amount of rupees 10,000, let's say principal amount is 10,000 and 10% rate is applicable, and the time of deposit is for 2 years, divided by 100, the interest which will be charged for 2 years, the simple interest we are talking about, it will be charged rupees 2000, right? So it will be 2000 rupees which will be charged as interest, right? For 2 years it is. So when we are talking about the simple interest, it is said as simple interest because we are going to calculate the interest for every year on the principal amount only, right? In case of compounding, what is done for each and every cycle, the interest is calculated on the last year total balance. But in the case of simple interest, the interest is calculated just on the principal balance and not on the total balance over. In case of banking, the simple interest is not calculated. It is the compounded interest which is calculated, but you should be knowing the basics related at how to calculate the simple interest, right? So the formula is quite simple. It is principal into rate into time, very much easier. Interest is a total amount of interest paid, and principal is the amount of particular amount which is lent over or borrowed, and rate is a percentage of the principal charged as a interest for per 1 year over there. It may also be the case that half yearly interest is being charged, right? Half yearly rate is being charged. In that scenario, what we'll be doing, we'll be multiplying the time by 2 and we'll be dividing the rate by 2, right? That will be done, right? So we'll be solving the questions based upon it. Let's have a look at it. So person purchases a car by obtaining a loan on simple interest. The car is costing 1,50,000. The interest rate on the loan is 10% per annum. If the loan is to be paid back after 2 years, calculate the amount of interest to be paid. So what will be the amount of interest? It is P into R into T. P is 1,50,000 over here. R is 10% and T is a tenor, that is 2 years, divided by 100, right? So we can be easily be solving it. So it is 15,000 into 2, that is 30,000 of the simple interest be charged. This is the total amount of interest that will be charged over the time period of 2 years. But what is the total amount that is to be paid back? It is principal plus interest is the total amount which is to be paid back. So that will be equivalent to 1,50,000. That is the principal amount plus 30,000 of the interest. So it is 1,80,000 rupees which is to be paid back to the lender, right? So now after that, let's learn the concepts about the compound interest. Now in compound interest, what happens? The interest is compounded over the years. Let's say case that we basically borrowed a sum of rupees 10,000, and further it is being borrowed at 10% per annum for 2 years. So this is 0 which is borrowed, and this is first year, this is second year. Now it will be, if we will be calculating the interest for the first year, it will be 10,000 into 10% into 1, that will be equal to 1,000 rupees. So 1,000 rupees of the interest will be charged for the very first year. No issues in that. But for the second year, the interest will be calculated not on rupees 10,000, but the accumulated amount, that is 10,000 plus 1,000, that is 11,000 over there. And what amount of interest will be charged? 10% will be charged. So it will be 1,100 rupees interest be charged for the second year, right? That is particular what, that is a compounding impact, that is a compounding effect over there, right? So the interest is not charged for a particular that on the fixed price only, but it is charged on the accumulated amount, right? So P over here is a here is the formula of the compounding interest, where A is actually related to the accumulated money. It is basically accumulated money, that is interest plus principal it is showcasing. And P is the principal amount, R is a rate of interest, and N is the number of years, or we can say simply tenor, right? This is how it is calculated. Now let's have a look at the question first of all. After that, we'll be coming back to it. So the question over here, it says the population of a town is increasing. It is increasing. The population of the town is increasing 8% every year, right? And if the present population of the population is 1 million, estimate the population 5 years hence. So here we are right now, if we draw it on timeline. So we are here right now and we are having the 1 million of the population. Is that clear? We are having the 1 million of the population, and here we draw 1, 2, 3, 4, and 5. We want to calculate the population over here, that what population will be here, right? And definitely the population is going to be having the compounding effect. It's not like the same rate of interest, same particular rate, it will be increased every year, but it will be increased on the accumulated basis, accumulation basis, right? So we'll be applying the compounding formula. What is the compounding formula? This is A is equal to P into 1 plus R raised to power n, right? And we have to convert R into decimal parts, so we'll be dividing it by 100. So this is how it is done, right? So now we are having the principal value of 1 million, means 10 lakh, right? And what is the value of R? It is 8%. So 8, that is 0.08. We can simply be writing 8 divided by 100, 0.08. And n would be equal to what? Because we want to calculate after 5 years, so raised to power 5, right? So now we have to solve this. So it is 1 lakh in 10 lakh into 1.08 raised to power 5. Whenever we have to solve such type of bracket, what we have to do on simple calculators, just simply press 1.08, multiply 1.08, and whatsoever the raised to power is, press equal to sign 1 less than it. So equal to sign is to be pressed for how many times? N minus 1 times. Here n is equal to 5. So equal to sign is to be pressed for 4 times. That will be giving you an answer. So now let's use a simple calculator so as to calculate it, right? So let us just calculate it. So 1.08 multiplied by 1.08, and then we'll be pressing the equal to sign for the 4 times. So 1, 2, 3 and 4. So it is 1.469, right? 1.469. So we'll be just writing over here. So 1.469 and multiplied by 10 lakh. So we are simply going to multiply it by 10 lakh. So it will be multiply. That will be giving us the value to be 14,69,328. 14,69,328. This is the population after the 5 years. So that is a question to the first answer. That is the answer to the first question. That is related to estimate the value after 5 year hence. Okay. Now after that, we have to calculate the another question that says also estimate the population 3 years ago. Ago means before, right? So here we have the timeline over here. So right now we are at 0, where the population is equal to 1 million, right? And here is -1, -2, -3. We have to calculate the value right now over here, right? So in this scenario, we'll be considering this value will be equal to what? This will be equivalent to accumulated value, because this is a value in future now. So we are saying that this is the accumulated value. So this is a value related to A, which is given over here. So we can simply be applying the same formula. A is equal to P into 1 plus R raised to power N. We can be filling the values into it. So it is 10 lakh is equal to P that we need to calculate, right? Because here over here, it will be P, and we just move to this particular value. We are saying that after 3 years, the value would be equal to 1 million. But we want to calculate the value of P over here, right? So it is equal to P, and the particular rate is same. So 1.08 raised to power 3. So again, we have to use a simple calculator. So 1.08 multiplied by 1.08, pressing it for 2 times. So 1.2597. 1.259712, right? So it will be equal to 10 lakh divided by 1.259712, right? That will be giving the value to be 7,93,832. That will be the answer, right? So the answer is 7,93,000 something, right? 93,832. This was the population 3 years ago, right? I hope that you must have understood the formula and answer related. Also, let's have a look at this particular example over here. So you borrowed rupees 1000 at 6%, right? So here the principal amount is given to be 1000, and 6% is what? This is the rate of interest. Then particularly in what particular amount it will be doubled. So this is related to rule of 72, that how much time it will be taking if you're basically applying the compounding, in how much time the amount will be doubled, right? Sometimes such type of questions can be asked, right? So now let's say we are having 10,000 rupees and we invested at 8%, and we are interested at in what particular time it will get double, that it will amount to 20,000. So rather than to calculate the particular things, we can simply be applying the rule of 72. What does rule of 72 says? That if the compounding is being done and we want to know that approximate number of years in which our money doubles with yearly compounding, that will be 72 divided by the rate of interest. Now here the rate of interest is 8. The approximate, it's going to take 9 years. It's going to take 9 years in which the amount will get doubled, right? So that is the case. It may also be the scenario where the compounding is done at a higher frequency rather than the compounding is being done at yearly frequency. Let's take a case that the amount being borrowed is rupees 1006%, and let's assume the amount was being borrowed for 4 years. 4 years, and half yearly compounding is to be done. We are just assuming the case, right? Half yearly compounding is to be done. So what will be the amount accumulated? So if we calculate the value as per the yearly compounding, the formula would be equal to 1000, that is a P, 1 plus R, that is 1.06, 6 divided by 100, that is 1.06. And for 4 years we are saying, so for yearly compounding the answer would be something like this, that is 1000 into 1.06. So 1.06 multiplied by 1.06 raised to power 4. So we'll be pressing the equal to sign for the 3 times. 1, 2, 3. So the value comes out to be 1.262 multiplied by 1000. Just calculated the answer for the same, and it will compound to 1262. If the yearly compounding is here, here we are considering the case to be of yearly compounding. We are considering the case of yearly compounding. What if we are basically compounding it at half yearly basis? If we are compounding it half yearly basis, the rate is to be divided by 2. So the new rate will be equal to R divided by 2, that is equal to 6 divided by 2%, that is 3% half yearly. 3% half yearly, right? And the tenor will be equal to multiplied by 2. So it will be 4 multiplied by 2, that is 8 half years. 8 half years, right? Now we'll be applying the formula. Same formula. So the principal is all same, 1000, and rate is 3% now, so 1.03 and raised to power 8. Now we have to solve this. So 1.03 multiplied by 1.03, and now we'll be pressing the equal to sign for how many times? For 7 times. So 1, 2, 3, 4, 5, 6, 7. So it is 1.266 multiplied by 1000. So the answer is 1266. Now see, mere by changing the frequency, the amount accumulated basically increased. So it means what? If the compounding do increase, in that scenario, you'll be earning more interest. In that scenario, you'll be earning more interest, right? So that is the case. Okay. After that, it's related to the fixed and floating rates. Now, what do you remember fixed rate and floating rate? Fixed rate where the interest rate is fixed and there will be no change during the tenure of the period, right? Period of the loan, there will be no change in the interest. Let's say case you borrowed interest, borrowed a car loan at 9.25% fixed rate. Now in that scenario, for the whole tenure, let's say the loan was borrowed for 7 years. For 7 long years, the same interest of 9.25% will be charged. No matter what market rate is, you'll be charged at 9.25%. But on the other hand, if you were being charged a floating rate or variable rate it is said to be, in that scenario what happens? With every repricing, the rate of interest will alter, right? Let's the case you borrowed the loan, housing loan at 8%, which is actually linked to the repo rate. Now let's say RBI reduced the repo rate. Previously, let's say it was 6.25% and now it is 6%. Let's just assume, right? In that scenario, your housing loan interest rate will also be repriced and it will reduce accordingly, right? Because the benchmark rate is changing over here. In case of floating rate, there is a benchmark rate. Benchmark rate is the underlying rate, is a underlying rate based upon which the interest rate is being calculated. The banks do earn a spread over it. Let's say case the benchmark rate is LIBOR, or let's say it is MIBOR, or let's say it is repo rate, right? It could be anything. LIBOR is London Interbank Offer Rate. MIBOR is Mumbai Interbank Offer Rate. Repo rate is the repo rate. Now we are considering, let's say, repo rate plus the spread. Let's say bank is earning the spread of 3%. So if the repo is 6.25%, the bank will be charging plus 3%, that is 9.25%. And what if the repo is now reduced to 6%? Now, particularly the margin is all same 3%. The particular rate of interest being charged on the loan will be reducing. That is 9%, right? And same way it can increase. Let's say case if the repo is increased to 7% plus 3%, now it will increase to 10%, right? That is the scenario of the floating rate. Floating rate. Now there is a repricing. Now repricing could be monthly, it could be quarterly, it could be half yearly, depending upon what kind of loan you have taken, right? And based upon the terms and conditions, right? After that, it's related to the front end and the back end interest rates. Now let's learn this particular concept of the front end and the back end interest rates. So in the case of the front end interest rate, when the particular amount is disbursed, let's say case you took a loan amount of rupees 10,000, right? And you basically borrowed it for the period of 1 year, right? At the rate of 10%. And the total interest which was to be charged, let's suppose it came out to be rupees 1,000 for one particular year, right? So now the total amount which will be disbursed to you will not be equal to 10,000, but it will be 10,000 minus 1,000. So it is 9,000 amount. The interest is already deducted, right? So this is what? This is the front end interest rate. This is a front end interest rate, right? That is the scenario. And what do you mean by the back end interest rate? It means the full amount, the full loan amount will be disbursed. You borrowed the amount of 10,000, you were basically disbursed with rupees 10,000, and the interest will be charged subsequently on monthly basis, quarterly basis, or the agreed basis, right? In general scenario, the back end interest rate is applicable, right? That is a scenario. And if the front end interest rate is applied, that basically leads to what? That an extra or more particular interest rate being applied, right? And the borrower gets a lesser amount, right? That is a scenario. And you should be understanding. After that, it's related to a very important topic, that is a annuities. This is the most important topic from this particular chapter. Now, when you are receiving a fixed series of a regular amount over a period of time, that is forming an annuity, or you are paying the amount. Let's say case you basically started a recurring deposit account and you're depositing the balances at the end of each and every month for 6 months. Now this is forming what? This is forming a annuity. Why? Because you're depositing a fixed amount of rupees 1,000. So amount is fixed and you are basically depositing the amount at a regular interval. So it is forming a annuity. And annuity is actually of two types. Annuities of two types. So when you are receiving or paying the amount in the beginning of the period, so if we are basically paying the amount or receiving the amount in the beginning of the period, right? In the start of the period, then it is said to be what? It is said to be the annuity due, right? Represented by AD. And if we're basically going to pay or receive the amount in the end of the period, in that scenario, it is what? It is a ordinary annuity, right? So it makes a lot of difference. How come it's going to make the difference? Let's understand this fact. Let's take the case that it's a timeline for 3 years. So this is 0, 1, 2, and 3, right? So first of all, we are considering that we are depositing the money in the beginning of the period. So in the beginning means we'll be depositing the money over here. 1k here, 1k here, and 1k here. We are depositing rupees 1000 in the beginning of each and every year. So here the interest will be applied for this period, and for this period. Here the interest will be applicable on 1000. Here it will be applicable on 2000, and here in the last year it will be applicable for 3000. This is a case of ordinary annuity due. This is a case of the annuity due. And what about the ordinary annuity? Let's understand this. Now, if it is a case of the annuity due, no amount will be deposited here, so no interest for this period. And the amount will be deposited here. 1k will be deposited here. 1k will be deposited at the end of the second year and at the end of the third year. Now, in this scenario, the person will be earning the interest on 1k for 1 to 2 years and on 2000 for 2 to 3 years, and no interest will be earned on this particular cash flow, right? So that is the case, and that is the difference between the ordinary annuity and the annuity due, right? And whenever we have to solve the questions related to annuity due, you have to make sure you'll be given with the data. You'll be given with data, and particularly you have to find out that you have to calculate the things for the present value or for the future value. So what do you mean by the future value? Let's say case if I am basically depositing the money in the beginning of the period, it's annuity due that I know now, right? But I am interested that what amount I'll be getting at the end of the 4 years. Now I'm depositing rupees 1000 in the beginning of each and every period. It's forming an annuity, right? All fine with it. But I'm interested what amount I'll be getting at the end of the tenor, right? So this is what this is the future value, because this is present in the future. This value is going to be there in the future over there, right? So that is a future value. That is a future value, right? And why you cannot be applying the compounding interest formula over here? Why? Because we are adding a particular amount to it each and every year, right? So that's why basically we cannot be applying the compounding interest formula. Compounding interest formula would be applicable if 10,000 rupees were deposited today and we were to calculate the value 4 years from now, right? So in that scenario, the compounding interest formula will be applicable. But here we are depositing or we are paying the amount in the beginning of the period or at the end of the period, and a particular interval is there, regular interval is there, and a fixed series of amount is being deposited or being paid, right? So here the annuity formula will be applicable. So you understood the concept related to the future value, because we have to calculate. These are the different cash flows. These are representing the different cash flows. And I'm going to calculate the value of this cash flow after 4 years, and this cash flow after 4 years, this cash flow after 4 years, and this cash flow after the particular period, right? So this is representing what? This is representing the future value. And in the same manner, it may be the case that the particular value is to be calculated for today value. Let's say case I am going to deposit the value. Now the 1000 I deposited today is valuing the same rupees 1000 itself, because it's in the same time horizon. But what about rupees 1000 that I'm going to deposit after 1 year? Is it going to be having the same value? No. Let me just quote an example to you. Let's take the case that you are having rupees 10 lakh today with you. Is it valuing more, or rupees 10 lakh that you will be having after 1 year will be valuing more? Definitely the value of money that you are having today itself in the present time is valuing more, right? Because it's due to the time value of money concept. It's due to the time value of the money concept, right? So the value of money that you will be having after a period will be lesser. So the value which you will be getting or you will be depositing after some particular period, if you want to calculate the today value of that particular value, today value of the amount that will be having in a future date, right? We are to discount that particular cash flow. So that is the funda. Okay. So whatsoever the amounts we are receiving in first year, we are to discount the value, right? We are to discount the value. So 1000 after 1 year, 2 year, 3 year, 4 year is not going to value the same. We are to reduce those values, and those values are reduced using the discount rate, represented by R. Discount represented by R over here. Is that clear? Is that particular thing clear to you? Right? So we have to use the discount rate. And further, when we are to calculate the future value, for the future value, we are to basically increase the value with the interest rate. So when particularly we are to calculate the present value, we are to reduce the value using the discount rate. When we are to calculate the future value, we are to increase the value using the interest rate represented by I. Represented by I. So interest rate is represented by I, discount rate is represented by small r here. Okay. So I told you about the ordinary annuity. Ordinary annuity is a case where we basically are going to deposit the amount or going to pay the amount at the end of the each period. At the end of the each period. This is said to be what? This is said to be the case of the ordinary annuity. And what about the annuity due where the payments are required at the beginning of the each period over there? That is the annuity due. So when we'll be solving the questions numerical based upon it, you'll be much more clarified, right? Now, let's have a look at the calculating the future value of an ordinary annuity. Future value of an ordinary annuity. What do you mean by ordinary annuity? That you are going to deposit or the amount is being paid to you at the end of the tenor. So 0, 1, 2, 3, 4 and 5, right? So I'm going to talk about the end of the tenor. So here I'm going to deposit rupees 1000 at the end of second year, third year, fourth year and fifth year. And what I'm interested into, I'm interested at what value I'll be having at the end of 5 years. At the end of 5 years, what value I'm having. So this is what value I'm to calculate. I'm going to calculate the future value of what annuity? Of the ordinary annuity, because it's related to the end of the tenor. So it is a future value of ordinary annuity. So we represent it by FV and for the OA, right? OA is for ordinary annuity, right? And we have to basically memorize a very easy formula. What is the formula? So I'm going to write the future value ordinary annuity formula. This is C into 1 plus R raised to power n minus 1 divided by R. This is the formula. This is going to be the formula and very much easier formula to memorize. So C is cash flow. R is the particular discount rate. But we are not going to write the discount rate over here because in the case of the particular future value, it is not represented by R, it is represented by I. Let me just change the particular formula for you. So it is going to be I, because for future value the interest is to be added to the value so as to get a higher value. So future value is always more than the sum of the individual cash flows, right? So 1 plus I raised to power n minus 1 divided by I. This is the future value of the ordinary annuity formula, right? And this formula itself can be deduced to the present value of the ordinary annuity formula. So I just told you one thing particularly, that if I take a summation of all the cash flows, right, that will be lesser than the future value. That will be lesser than the future value, right? So future value is more than the sum of the cash flows individually, because some interest is to be added up to that particular value, right? So let's just take an example. Let's take the case I was depositing rupees 1000 each and every year for the 5 years, right? For 5 years. And let's say I was depositing at interest rate of 10%. 10% per annum interest rate was applicable. And I'm depositing these cash flows at the end of each tenor. That is, annual interest of 10% would be applicable. So N is 5 over here because it is for 5 years, and cash flow is going to be what? It is going to be 1000 over there. Just simply putting the values over here. So it is 1000 and further 1 plus. Now the decimal part is to be taken. So it is 0.10 raised to power 5 minus 1 divided by 0.10. That would be it. Just going to solve this particular thing. So it is 1.1 multiplied by 1.1 and raised to power 5. So we are going to press the equal to sign for 4 times. So 1, 2, 3, 4 minus 1 divide by 0.1, right? Divide by 0.1. So it is going to be somewhat different. So 1.1 multiplied by 1.1 and raised to power 5. 1, 2, 3, 4, right? And further minus 1. This is going to be 0.61051 and divide by 0.1. That is 6.1051 and multiplied by 1000, right? So the amount will be 6105. So the amount after 5 years, the future value we calculated to be 6105. This is going to the future value, right? So 6105 is definitely greater than that of the rupees value of 1000 over there, 5000 over there, right? So this is a future value we calculated. And this same formula can be deduced to what? This can be deduced to the present value of the ordinary annuity. So present value of ordinary annuity formula would be somewhat the same. C into 1 plus I, because in case of present value you are to reduce the value. In that case I will be changed to R, right? So it will be 1 plus R, that is a discount rate raised to power n minus 1 divided by R. Instead of I will be writing it as R, and the same numerator term over there, that is 1 plus R raised to power n. That is it. That would be it. This is a formula for the present value of the ordinary annuity, right? Now you just know the formulas, right? And I already told you related to the formula of the ordinary annuity also. So here is the formula which is written over here. You can simply be finding that this formula is all same. We just change the I to R, right? And just added a new term to it, that is 1 plus R raised to power n. That's it. That is it. And we basically learned two formulas from it, right? We learned two formulas from it. So I'm just writing the formulas again for you. So the future value of ordinary annuity is particularly equal to C into 1 plus I raised to power n minus 1 divided by I. This is a formula for the future value. And if we talk about the present value of ordinary annuity, same thing. C into 1 plus R. Instead of I, we are going to use R raised to power n minus 1 divided by R, and 1 plus R raised to power n, right? And what about the annuity due? So if we are to calculate the formula for the future value of the annuity due, same formula, same formula. C into 1 plus I raised to power n minus 1 divided by I, and one extra term, because I told you above example also that one extra term is there, right? I just told you, that if the timeline is there and I'm going to invest the money for 3 years, 0, 1, 2, 3. So in the case of the ordinary annuity, I'll be depositing money here, here, and here, annuity due, right? So here interest will be given, here interest will be given, here interest will be given. But in case of the particular and ordinary annuity, in case of annuity due, extra interest is there for one particular period. And in case of the ordinary annuity, 0, 1, 2, 3, we'll be depositing money here, here, and here. Here no interest will be applicable, here applicable, and here applicable, only for 2 terms. Here the interest was applicable for 3 terms, here the interest was applicable for 2 terms. That is why in case of the annuity due, one extra term is added up, 1 plus I is added up, right? So that is a formula for the future value of the annuity due, right? Right, okay. After that, it's related to the present value of the annuity due. Same formula as it is. So C into 1 plus R. Now, when we are talking about the present value, I is to be replaced by R. That is a discount rate. Minus 1 divided by R into 1 plus R raised to power n, and multiplied by 1 plus R. That is it. This is it. You just memorized 4 formulas from one single formula. You just need to memorize this formula and you will be able to learn 4 formulas from the same, right? Now we'll be solving a question based upon it, and after that we'll be coming back to it, and further we'll be solving that particular in another video. But now we are going to solve one particular question from it. Okay, now I'm just giving a question. Let's take the case that you are receiving a sum of rupees 5,000. You're receiving rupees 5,000 in the beginning of the period. Right? And for the discount rate is given to be of 12%. Discount rate is applicable of 12%, and you are receiving the money for 5 years. And we are interested in the present value, right? We have to calculate the present value. What formula we will be applying? Now, first thing first, we know that we are receiving rupees 5,000 every year, so it is forming an annuity first of all, and we are receiving it in the beginning of the rate, so it's a case of the It's a case of the annuity due, right? And we have to calculate the present value. So present value of annuity due formula would be applicable. Okay, and the formula is quite simple. C into 1 plus r raised to power n minus 1 divided by r into 1 plus r raised to power n and multiplied by 1 plus r. That's it. This formula is to be applied. Now just replacing the values over here. So C is 5000. That is a particular cash flow. 1 plus r. R is given to be 12%. So it is 1.12 for 5 years it is. So raised to power 5 minus 1 divided by 0.12 and again 1.12 raised to power 5 and multiplied by 1.12. That is it. This is what we need to solve. So first of all, we are going to calculate the value of 1.12 raised to power 5. So it is 1.12 multiplied by 1.12 and equal to sign for 4 times. So 1, 2, 3, 4. So it came out to be this particular value. This came out to be what? 1.7623. This is the value, right? So minus 1 and further divided by 0.12 and further divided by 1.7623 again, because this is the same term in the denominator also. So the whole term came out to be 3.60 multiplied by 1.12 and further multiplied by 5000. So the value, the present value came out to be 20,187. So even if we are receiving the money for 5 years and particular amount we received rupees 5000 for the 5 years, and if the discount rate of 12% is applicable, the present value that meant to be that we are going to receive today is, if we're going to convert the cash flows that we are going to receive every year, if we're going to get the present value of the same, it will be 20,187 only, right? So that is how we are going to solve the questions, and that would be it. I hope that you must have liked the video and the concepts of it. So if you like the video, just do give this video a thumbs up and don't forget to subscribe to our channel. And if you want to get the PDF of the same, just do WhatsApp us writing the JAIB and save this number 8360944207 and we will be adding you to the update list. So that will be it. Thank you so much and happy learning.